So where do you come down on this, Steve, as you're thinking about what happens next, Steve Weiss?
You know, I sort of go back and forth, candidly, Scott. I mean, I think the Fed can not hike and still get their message very clearly across. So right now I'm 50-50, and that's changing minute to minute. So inflation's still stubbornly high. We've gone through the easy part of taking inflation down, right? And now will stay at 5 to 6% for a while. The risk to the Fed is that the markets then open up again, that you have liquidity because everybody says the market's done, and then everybody parties on. So they've got to be very careful.
I don't know about that. I don't know about that. I mean, I think this time may be a little different, right? There was a big shock this weekend, and I don't think it's okay, you know, they're not going to go next week. It's party on. I think part of them not going next week is, okay, this is legit in terms of the seriousness of it, and it's not. Let's just start throwing money hand over fist into stocks.
Right. So let me finish. So I think that they can do the same thing with very strong messaging, saying that we're not done necessarily. We're going to watch it. If inflation remains high, we'll be coming back to it. And at this point, I believe Powell's got enough credibility in the tightening cycle where he can get away with that. Look, what we're seeing in the market is playing out according to script, and not SVB. That I don't think anybody predicted that, except maybe some who were shorted. But in terms of not knowing where you're going to see the effects of the Fed's massive tightening cycle. It happened to be there, but I can guarantee you it's going to be in other places. So I believe the debate between whether it's a hard landing or a soft landing, it's ridiculous. It's great cocktail talk, but the point is the economy's direction is down. The market direction is down. So that's really all you have to know at this point. And the Fed, the important thing is that while we're seeing the SVB issue and the tightening of lending standards, absolutely, that you're just at the tip of the spear in terms of the impact of the Fed tightening cycle because of the lag. So there's no way, in my view, that the market's going up. Market still is the easiest to analyze I think I've seen in 30 years being in the market at this point.
Yeah, no, you've been on the right side of it from the get-go. That's been clear to all of us and our viewers, too, I think, at this point. By the way, the Dow's down about 657. I'm looking here at the bottom of the screen that's in front of me here. That's better than 2% decline for stocks. All right, Bryn, just threw the ball to you. You want to run with it where?
Yeah, well, I want to hit on two things. I want to go back to what Joe said about, you know, this reallocation continues. He's very spot on as people are selling commodities, selling financials, moving into technology. My question, though, is that I'm asking myself, if we go into this contraction, as I thought we should continue to go through the economic cycle, I don't think we continue to have this reallocation, because once you go into a contraction and if things continue to break, what you don't want to own are economically sensitive areas like financials, industrials, real estate, and energy. And so right now, technology is definitely held up. It's doing very well. It's, you know, but my question is, I don't think that actually does continue, because I think the whole market as a whole will have to price lower if we continue to get these breaks. Because if the Fed does have a Fed put, it's not at 3850 on the S&P. That is not happening. And so it would have to be much lower. So I still think investors need to remain incredibly cautious, defensive, because to Steve's point, I think this is the tip of the spear on what else happens next. And the markets are going to remain really skittish on any type of news that comes out, like the Credit Suisse, which is really like a penny stock and shouldn't be that big of a deal. But it is a big deal today.
Yeah, well, it's been a big deal that's been sort of simmering, festering for a while. Wolf Research, by the way, says the Fed put is back in place. Ed Yardeni made the argument here yesterday that the Fed put is back. Jason Snipe, what's happening, as Joe was just pointing out, as Bryn was talking, is oil's slide continues. 66 bucks, 66.44 is where I'm looking at the oil trade. You could probably overlay an S&P chart or a Dow chart to crude today on an intraday basis, and as crude goes lower, the market goes lower. Your thoughts on that?
Agreed, Scott. So oil obviously is down 11% year to date, and what I think is being baked in is a recession. a recession sooner than later, and that's likely usually when we see oil prices start to pull back the way that they are. And there's really no cred to China coming back online. Generally speaking, that would be inflationary for the oil trade, but it's really not. And I think there's just overall risk-off sentiment is not great, and I think that's why the energy trade is pulling back. And remember, energy was a great contributor to earnings this quarter, but that's likely also going to slow heading into the rest of the year. So there's definitely concern, with energy below, trending at 70 and below 70. I think that's definitely a concern going forward for the markets.
Bill Baruch,
Yes.
What are you gaming out here?
Ironically, today's first quarter GDP, Atlanta Fed GDP now, is moved up to 3.2%. I mean, that's probably a gasp for air. We're probably going to see that come back in a bit. But the Fed
you think?
yeah, I think so.